Power has a temptation. It whispers a simple promise. If you are strong enough, markets will obey. If you are bold enough, risk will vanish. Last week, that idea walked straight into the White House. President Donald Trump faced nearly 20 of America's most powerful oil executives, and he made them an extraordinary offer. Invest $100 billion in Venezuela, rebuild its broken oil fields, and in return, he promised total security, total safety, total protection. The objective sounded clean: more Venezuelan oil, lower global prices, oil at $50 a barrel, relief for American consumers. But here is the friction point. Oil companies do not operate on confidence alone. They operate on law, on contracts, on predictability, and Venezuela, as one executive put it bluntly, remains uninvestable. This is not just an energy story. It is not even just about Venezuela. It is about the limits of power in a world governed by systems, not slogans. If you want to understand where politics ends and reality begins, stay with me, because what happens next will shape far more than oil prices. And if this perspective matters to you, keep watching. To understand this moment, we need to slow it down and separate vision from structure. What President Trump proposed was not a normal investment pitch. It was a political solution to an economic problem. Global oil prices are volatile. High prices fuel inflation. They anger voters. They punish governments. So the idea was direct: revive Venezuela's oil sector, add supply fast, force prices down. But this plan rests on a critical assumption: that political authority can substitute for institutional trust. Venezuela is not short on oil. It is short on stability, on legal certainty, on enforceable contracts. American oil companies know this landscape well. They have operated there before. They have lost billions there before. That history matters because capital has memory. Trump's promise of total security tries to override that memory. But without details, protection remains an idea, not a system. And when governments ask companies to take enormous risks, one question always follows: who pays when things go wrong? That question leads us backward in time and straight into Venezuela's recent past. To understand why Venezuela reached this point, we have to look backward. Not years, decades. Venezuela was once an oil success story. One of the richest energy producers in the world. Oil funded schools, hospitals, infrastructure. Then the system changed. The state took control. Politics replaced management. Loyalty replaced competence. Oil revenue stopped being investment capital. It became political fuel. When prices were high, the flaws stayed hidden. When prices fell, everything broke. Contracts lost meaning. Courts lost independence. Foreign companies lost protection. Assets were seized. Operations stalled. Billions disappeared. Production collapsed. Not because oil ran out, but because institutions did. This is the cycle resource economies fear most. Boom without reform. Power without accountability. Collapse without recovery. So when today's executives here come back, they remember this history. They remember exits that were not voluntary. That is why Venezuela is not just risky, it is structurally broken, and that history sets the stage for the first real shock in this story, because words soon collided with reality. The first shock did not come from Caracas. It came from the boardrooms. Inside the White House, the pitch was bold. Spend $100 billion. Rebuild fast. Change the global oil market. But the response was not enthusiasm. It was hesitation. One executive after another raised the same concern. Not politics. Not prices, but rules. ExxonMobil's CEO said it plainly. To return again would require significant changes to the legal system, to the commercial framework, to the foundations of investment itself. This was not defiance. It was realism. These companies had already entered Venezuela once, then twice, and each time they left poorer. So when asked about safeguards, the answer was revealing. The companies, the president said, know the risks. That sentence landed heavily because it shifted responsibility from the state to the firm, from policy to profit. At that moment, the gap became clear. Power was offering ambition. Capital was demanding structure. And when those two failed to meet, deals collapse. But the deeper danger was not the rejection itself. It was what the proposal revealed about the system behind it. Because the real mechanism was only just coming into view. What was being proposed was not just drilling, it was control. Under the plan, oil would flow. Revenue would flow too, but not freely. Money from Venezuelan oil sales would move into accounts overseen by the United States, not Caracas, not private firms. This changes the nature of the deal. Oil becomes leverage. Revenue becomes governance. Investment becomes a tool of political supervision. From one angle, it sounds stabilizing. From another, it signals occupation by accounting. For companies, this creates a new risk. Not expropriation by Venezuela, but dependence on Washington. Who enforces contracts when politics shift? Who guarantees safety when administrations change? Who controls the exit? These are not abstract questions. Oil projects last decades. Presidents do not. The plan assumes continuity of power, but markets price discontinuity. This is the hidden mechanism. Political authority trying to replace institutions, security guarantees replacing rule of law. History tells us this rarely works. When systems rely on personalities, they fail when personalities leave. And once investors see that, confidence evaporates. That brings us to the second moment of escalation, because the logic of control did not stop at oil. It extended far beyond Venezuela. The second escalation came quickly, and it was unmistakable. At the same meeting, President Trump shifted the conversation from oil to territory. He spoke openly about acquiring Greenland, a self-governing territory linked to Denmark, a NATO ally. The message was blunt. If the United States does not take Greenland, others will, China and Russia. He described two paths, the easy way or the hard way. This matters because it reveals a pattern. Economic leverage, territorial ambition, security framed as necessity. Together, they signal a worldview, one where power must expand to remain safe, where control is prevention. But for allies, this creates alarm. For investors, it creates uncertainty. If borders become negotiable, rules become fragile. If alliances become optional, risk premiums rise. Markets listen carefully to these signals. They price them in immediately. The danger is not aggression alone. It is unpredictability. And when unpredictability spreads, it does not stay contained. It moves from diplomacy into balance sheets, from speeches into supply chains. This is where geopolitics stops being abstract and starts touching ordinary lives. Because the costs of uncertainty never stay at the top, they travel downward. This is where the story reaches you, not executives, not presidents, you. Because when global oil strategies wobble, the impact does not stay in boardrooms. It moves fast into your daily life. Higher risk means higher prices. At the pump, at the grocery store, on your electricity bill, when investors hesitate, supply tightens. When supply tightens, costs rise. And you feel it before anyone explains it. You are told prices are temporary. That relief is coming, that markets will adjust. But uncertainty has a cost, and that cost is passed down. You pay it in inflation, in slower growth, in fewer jobs tied to energy and manufacturing. What makes this moment different is the source of that uncertainty. It is not war, not disaster, but policy ambiguity. promises without structure, security without systems. And when trust erodes, everyone absorbs the shock. If you're trying to understand why global decisions feel personal lately, this is why. If this analysis helps you see the system more clearly, stay with me, because what happens next does not stop at borders. It spreads outward. The effects do not end at home. They ripple outward. Venezuela sits at the crossroads of energy and geopolitics. Any shift there touches multiple continents. If American companies re-enter under political protection, others take note. Russia watches. China watches. So do energy-hungry nations across Asia and Europe. Control over oil supply is control over leverage. And leverage reshapes alliances. A US-managed Venezuelan oil flow would alter trade routes. It would challenge existing suppliers. It would pressure fragile economies that rely on higher prices to survive. At the same time, allies grow uneasy because when one country claims long-term control over another's revenue, sovereignty blurs. The United Nations has already raised concerns. So have international partners, not because oil is moving, but because precedent is being set. Once energy becomes an instrument of governance, neutrality disappears. Every barrel carries politics. Every contract signals alignment. That is how regional plans become global tensions. Quietly, gradually, and history shows us this pattern. Energy shocks rarely stay local. They redraw maps, which brings us to the question everyone avoids. Where does this lead next? The answer depends on which future unfolds. There are three paths forward, and each tells us something about power. The first is the optimistic path. Institutions are rebuilt, legal systems are repaired, contracts become credible again, investment follows rules, not rhetoric. Venezuela stabilizes. Oil flows without coercion. Markets respond calmly. This is the future of reform. It is slow, it is boring, and it works. The second path is the middle ground. Partial control, limited investment, ongoing political guarantees. Oil increases, but cautiously. Prices ease, but volatility remains. This is the future of managed risk, neither stable nor chaotic, just fragile. The third path is the dangerous one. Power replaces process. Security replaces law. Control replaces consent. Investment hesitates. Allies distance themselves. Markets price fear. Oil becomes a weapon, not a commodity. History is clear on this. Systems built on force do not endure. They accumulate pressure until something breaks. Which path we take will define more than energy policy. It will define whether global order is governed by institutions or impulses. And that brings us to the final question. What should we take away from all of this? Because insight without action changes nothing. Here is the lesson this moment leaves us with. Power can open doors, but it cannot replace trust. Markets do not run on confidence alone. They run on rules, on institutions, on predictability that survives leaders. What we are watching is a test of whether political force can shortcut economic reality. History suggests it cannot. When governments promise security without systems, risk does not disappear. It only changes hands. And eventually, it comes back with interest. Venezuela's oil is not the real prize here. Control is, and control is always tempting. But the modern world is not held together by control. It is held together by legitimacy. If that lesson is ignored, energy will become unstable. Alliances will weaken, and ordinary people will keep paying the price. If you want to understand where the world is heading, do not just watch elections. Watch institutions. Watch how power treats rules, because that tells you everything. If this analysis helped you see the system more clearly, share it. Stay with this conversation and watch what comes next.